Hey everyone, what's going on? Today we are talking about the history of the Federal Reserve, looking at its founding and sort of how banks work in the US. I'll keep this intro super short and sweet, but if you're enjoying these series, please leave a like and subscribe. Thank you so much, which we will talk about. But first I want to talk really quickly about how the US banking system works, and I guess every banking system. There's a couple notable exceptions in the crypto world that don't use fractional reserve banking and use full reserve banking, and basically we'll talk about it in a bit. But fractional reserve banking is how banks make money. Basically, the bank can give you interest on your savings account because it takes the money in your savings account and loans it out to other people. So say you put $100 in the bank is going to take that $100 and put $10 into its own reserves and put the other $90 into a loan that goes out to somebody else who wants to buy a house. And if you were to want your money back, the bank would come, and you walked in the bank and said, "Hey, can I get my $100 back?" The bank would go into its reserves and get your $10 out of the reserves, and it would grab 10 other people's money from the reserve because it can't really pull from, the value of the house that somebody is building that they had taken the loan out for. And will have tangible value, but isn't finished yet or isn't in a time frame where it's producing value. And so when I say banks are built on trust, this is what I mean. Banks don't actually have all of the money that you give to them stored within them in some vault somewhere. That's not at all how banks work. Most banks store a small percentage of the money you give them and loan out the rest several times over in order to make profits and make their operating expenses back. And so a bank run happens when everyone tries to get their money out all at the same time. And so basically what it is a lack of confidence or trust in the bank or the market. And so when this happens, because the bank has loaned out so much money, it's all well and good if, one single person walks into the bank and wants to pull out my money. When it becomes a problem is when everyone is trying to pull out their money. And so if I pull out my money and then go home and say, "Hey, I heard the bank say they're running out of money," and everyone else comes running into the bank and tries to pull out their money, the bank is actually going to run out of money. And when it does run out of money, everyone says, "Oh my God, the bank's run out of money. You should go get your money out of your bank because you want to get it before your bank doesn't have any money left." Basically, it creates this really nasty negative feedback loop that keeps building on itself and getting worse and worse until somebody comes in who is a trusted party who can restore faith in the system as a whole. And basically what this looks like is either a sort of industry baron or think like JP Morgan, Rockefeller, Carnegie, industry baron level person, or a government of some type. So US government or whatever your national government may be. I know it's happened in Britain, and I believe it's happened in Greece as well. Also, I said I would get back to full reserve banking really quickly. My footnote on that is crypto sites are professing to be the first sort of full reserve banking, and how they work is they don't charge. They're more custodians of your money. They don't actually loan it out or do anything with it. They're simply holding it, and you get charged account fees or maintenance fees as time goes, and that's how they make their money. And so they are more of a sort of vault like impenetrable vault that you don't take out of, rather than sort of the bank model where you put your money into the bank because you have faith that the bank will make good loans and pay you back a little bit of interest in on the money you have given them. So after this panic of 1907, there was 6 years of debate, and there was a committee created that was sort of a Band-Aid stepping stone provisional thing that bridged from this '07 crash or panic, and bridged them into 1913 when they actually created the Federal Reserve, which was basically a compromise between three very distinct parties. One of like Wall Street saying, hey, regulation is bad, we don't need regulation, blah, blah, blah. Another was the conservative Democrats, who were saying, hey, you should regulate this, but it shouldn't be to a degree that it affects individual people. And then there was also a sort of liberal Democrats, which were like, everything needs to be regulated. We can't have this happen again. And so, sorry, I should have added this before, but an important footnote for the other one for this slide was the trusted party that stepped in to fix this was J.P. Morgan. He financed the banks and trusts that were short of money, and came out and basically said, hey, I will give these banks and trusts enough money to cover all of their operating expenses, and make sure everyone is made whole on their deposits. But you guys all have to work together to make sure this doesn't happen again. From that, there was sort of that gets us really quick catch back up to today, or not today, to 1913, where we have the system that's created where it's 12 regional banks and each oversee its own sort of area. And in order to do this, they all have distinct regions that they oversee, and they don't sort of interact with one another under the model where it was created. I also thought this popular political cartoon from the era was interesting to show. It shows sort of the octopus, which is the National Reserve Association, one of the groups that was lobbying hard. And it's got its tentacles reaching into every facet of the government, and it's just pouring money into the New York Stock Exchange, which I thought was very, very interesting. But back to the Federal Reserve. After it was created, it basically was thrown into World War I, where it had its first major test of what it wanted to do, and how it was going to operate. And overall, it was very tied to the Treasury, who said, make banks buy government treasuries. And so what the Federal Reserves did was they offered loans at below market rates for buying government treasuries. And this effect worked pretty well and became sort of the first major lever we see them pulling on. It's the first major lever we see them pull as a tool to alter monetary policy in the U.S. So this is a graph or not a graph, but a map of all of the different districts, and they're sort of off. What are they called? Like the main location, as well as like their different branches. So the red dots are branches. The black squares are the main branches. And it's very interesting to see how clumped they sort of are up here and how much more spread out they are over here. So the idea was these states had a lot of economic power and they wanted to spread out more power to this side of the country. Excuse me.